Hi, this is Andy Filipiuk in Toronto for the week of October the 10th. Yesterday we sent out the third quarter results for the permanent portfolio. We're currently down 8.4% year to date, which is disappointing given how stable this portfolio has been over time. But we sold off hard in the end of the third quarter on poor economic news and continued tough talk by the Federal Reserve in tightening interest rates. Last week I mentioned how the Bank of England was forced to step in and bail out the British pension system. They were buying 30-year bonds that had hit 5%, they dropped to 4.5%. Well, this morning we're seeing the same problem. The Bank of England yesterday had to go back in as the bond yields are now back above 5%, trading around 5.03%. So the Bank of England that had stated in August that they would begin quantitative tightening is now doing more quantitative easing. So this is important for portfolio holders. All the tough talk by the Federal Reserve can be upset by financial crises. Thus far, we've seen the Bank of Japan was forced to step in and buy bonds, which is effectively quantitative easing. The Bank of England is still in there doing quantitative easing. And most interesting, yesterday it was reported that the Federal Reserve did a swap line with the Bank of Switzerland, the National Bank of Switzerland, for $3.1 billion, which highlights that Europe is desperate for dollars. So the fact that the Fed has begun, and this is printing money as well, to send money to Europe to help stabilize the banking system shows while they're talking that they're going to continue to raise rates, behind the scenes they're starting to loosen. Now, I don't think they can go much further, and that should help stability in the markets. But until then, markets are going to be volatile and very frustrating. But I'm confident that we're close to the end of the tightening as financial conditions show that they just cannot continue to do this without breaking more markets. Thanks for watching.